This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 507 was produced on November 20th, 2025. I'm Eric Townsend. With everyone questioning whether the bull trend in equities is topping out, this is a perfect time to take a deep dive on the 65-month global liquidity cycle. So Global Liquidity Indices CEO Michael Howell returns as this week's feature interview guest. We'll discuss the global liquidity cycle, why it has a 65-month periodicity, and where we stand in that cycle right now. We'll also discuss why Michael thinks that the period of equity outperformance is probably winding down and why commodities outperformance likely comes next. Then be sure to stay tuned for our Trade of the Week segment right after the feature interview, when Patrick will translate Michael's outlook on interest rates to an option spread trade on SOFR futures. In observance of the American Thanksgiving holiday, MacroVoices will be released one day early next week on Wednesday, November 26th.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, November 19th, 2025. The S&P 500 index down 304 basis points, trading at 66.42. The market has now finally experienced the first peak to trough 5% market correction since Liberation Day. We'll take a closer look at that and the key technical levels to watch during the postgame segment. The US dollar index up 64 basis points, trading to 100.11. The breakout in the US dollar continues. The December WTI crude oil contract up 63 basis points, trading to 59.25. The December RBOB gasoline down 159 basis points, trading at 186. The December gold contract down 311 basis points, trading at 4,082, remains in consolidation after that strong third quarter bull run. The December copper contract down 176 basis points, trading to 501. Uranium down 225 basis points, trading at 76.15. And the U.S. 10-year Treasury yield up 4 basis points, trading at 4.14. The key news next week is to watch the inflation numbers, which is both the PPI and the PCE price index, as well as the retail sales numbers into a shortened holiday week. This week's feature interview guest is Global Liquidity Indices CEO Michael Howell. Eric and Michael discuss global liquidity, its impacts on markets, repo stresses, China, and more. Eric's interview with Michael Howell is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Michael Howell, CEO of Global Liquidity Indices. And boy, what a perfect time to get Michael on the show. Michael prepared a slide deck to accompany today's interview, which I strongly encourage you to download as we'll be discussing those slides throughout the interview. There are also two research notes which are very much worth reading. One of them is called A Giant Hissing Sound, and it's exactly about this drying up of global liquidity that's occurring in markets. Michael published that long before the market events of the last week or so. So he's definitely got some prescience in terms of what was going on in this market. The second download is called The New Currency Wars and the Gold Bitcoin Axis, America's Digital Collateral versus Chinese Gold. Both of these papers are very much worth the read. Just for our listeners' benefit, we're recording this interview early on Tuesday morning. So Michael and I are aware of the market carnage, which brought us to the first sell-off to a closing print below the 50-day moving average on S&P E-mini futures since the 21st of February in 2025. The last time this happened, it was 1,200 points down from there before it bottomed. Michael, is that about what's going to happen next, or is this one going to be shallower?
Oh, hi, Eric. It certainly could be. I mean, I think the concern is that we've been in a bit of a bubble, I guess, and liquidity is basically being pulled from markets. And liquidity has been a major driver of asset prices, really, well, as long as I can remember, in fact. But I mean, certainly since the low point in late 2022, markets have catapulted upwards by more liquidity. And it looks as if this is sort of coming to an end, or certainly at least for the short term, if not well into 26.
Now, I want to compare this. I agree with you completely that, boy, liquidity is everything to markets. It does seem like the technical indications are giving us a signal we haven't seen since February. That was pretty nasty in February. This could be big. The other side of that, though, is our good friend Eric Peters over at One River Asset Management has a note out saying, look, President Trump has never had more at stake than he has right now. If the Democrats take control of the Congress in the midterm elections in 2026, we're going to go back to lawfare, probably another impeachment. Who knows what could happen. On the other hand, if he can get through this and somehow make sure that Republicans win in 2026, then the rest of his presidency, and he can't run again, so this is the end of his presidency, it sets him up for the legacy that he wants to have. So what Eric Peters is saying is, boy, there's never been a stronger incentive for Trump to pull out all the stops and do absolutely any policy action that it takes to turn this around. So I guess the question in my mind is, okay, are there any policy actions that can turn a drying up of global liquidity around? And I agree with you. It's not just U.S., it's global liquidity that seems to be drying up. Is there some trick up Secretary Bessent and President Trump's sleeve that could reverse all of this?
Well, I think there's a lot of things out there, and I'm absolutely sure that they're focused very much on the midterms. So I'd be surprised if they do nothing from here. But the question is, do they really try and goose Wall Street, or do they put more stimulus into Main Street? And I think everything that we're hearing out of Treasury Secretary Bessent is that we're basically moving towards an environment where it's quite likely that Main Street is going to get the thrust of any policy impetus. Now, I think you can kind of see that in some ways by listening to some of the Trump appointees on the FOMC, notably Steven Miran. And, what he's saying is that sort of very curious combination of let's cut interest rates, but also let's shrink the Fed balance sheet. Now, that's kind of a head-scratching point because it's kind of difficult to do that. But at the end of the day, what they're really saying, I think, is that lower interest rates will likely help Main Street, but smaller balance sheet is going to take some of the impetus or some of the liquidity away from Wall Street. And that maybe is what they're thinking of doing. And it's really in this sort of camp that I kind of describe as, a shift from Fed QE towards Treasury QE. And that, I think, is really the direction of policy. The problem is it's very difficult to sort of fine-tune that withdrawal of liquidity from Wall Street without causing the markets some tensions. And I think we're kind of seeing the early signs of that now in the repo markets. We haven't seen these kind of tensions in repo really since 2019. And the script is looking very similar. So you're seeing sort of a run of excitement or sort of wider spreads in repo. And then suddenly, as in 2019, you get an unexpected blowout. And that could be happening again. So we just got to be really, really careful about monitoring some of these issues.
Michael, let's tie this conversation into your slide deck. Walk us through what's going on and what we can expect next.
Okay, well, let's start on slide 11, which is a little way in, but it gives you the sort of essence of what I've just been talking about, which is looking at the global liquidity cycle. Now, what this chart is identifying is the momentum of liquidity through the world economy. Now, I think we've got to be clear about a couple of things. One is, what is global liquidity? And the way that we define it is it's the flow of funds through world financial markets. Now, is that money supply? The answer is, it's not. Probably an easier way to understand what we're doing is to say that this aggregate is really financial money, but it pretty much begins where conventional M2 measures of money supply end. So it's really looking at that sort of fringe of funds which are, in repo markets, flowing through shadow banks, etc. These kind of more esoteric areas, but it's that which tends to drive a lot of the leverage in the financial system. And it's very cyclical, as the diagram says. So the black line there is the momentum. It's shown as an index, but it's basically the underlying growth rate of liquidity. And what we've overlaid on top of that is a sine wave that you can see as a red dotted line. Now, that sine wave was actually put in place 25 years ago, back in the year 2000. It was estimated, for those that are mathematically inclined, by Fourier analysis. And it's basically been extrapolated thereafter. So, what you see is what you get. It's a 65-month cycle. Interestingly, by coincidence, the Foundation for the Study of Cycles, which is an institute that looks very closely, as the name suggests, at cycles, took the data away and did their own independent analysis, much more rigorously, I'm sure, than we did. And they came back with exactly the same conclusion, that it's a 65-month cycle. So there's independent sort of corroboration here. And the other question is, why is it 65 months? And our best rationale is that this is a debt refinancing cycle. As we've noted before, capital markets are not, as the textbook suggests, mechanisms for raising new money for new investment projects. They're much more systems for debt refinancing. And we've got so much debt, something like 70 to 80% of all transactions in financial markets are about debt refi now. So this is a debt refinancing cycle, and the average maturity of debt out there in the world economy is around about 5.5 years, which is exactly the 65-month cycle. So that's probably what it is. And you can see from the cycle that we last bottomed in late 22. In fact, it was October of 22. The cycle has been moving up pretty nicely, almost in a straight line ever since. But it's just beginning to inflect, and it's inflecting pretty much round where that sine wave is suggesting, late 2025, early 2026. And that's why we're concerned, because we're seeing this downward momentum, and that's coinciding with where the cycle the rhythm would normally start to turn down. So that's our concern. And if you go to the next slide, that basically encapsulates that by looking at the current cycle and comparing it with the average cycle over the period since 1970. The average cycle is that black dotted line. The zero is showing at the middle of the chart is the low point. The months before and after that low point are shown at the bottom, counting to the left and to the right. And the red line is the current cycle. So it looks as if we're pretty much sort of at the end of what is a normal cycle. Now, there is tolerance either side of that average, and the tolerance has been on average about 8 months. So, you've got a window there of some flexibility, but it looks as if we're getting pretty late. That's the story. And then, if you want the implications, then take a look at the following slide, 13, which is just a schematic diagram that looks at the asset allocation cycle and tries to overlay the liquidity cycle, which is shown on the left, onto the asset allocation cycle, which is shown on the right. And it basically infers that if you're in the upswing in the phases that we describe as rebound or calm, you're likely to have strong performance from equities. Around the peak of the cycle, you tend to find commodities picking up strongly. In the downswings, you want to be moving back to cash as the asset that gives you the better absolute returns. And then around the trough of the cycle, you want longer duration government debt. And then the cycle starts again. You go from risk off back to risk on. And that's effectively how the cycle tends to work. Where are we now? We're basically around the peak. In the US market, we reckon Wall Street's in what we call a speculative phase in terms of liquidity, let's be clear. Other markets are nearer the peak, maybe Europe, emerging Asia, and much more in the sort of the very late calm phase. But you get the idea. We're late in this cycle.
I want to make sure that I'm not reading too much into this, because as I go back to page 11, this looks pretty ominous. It says that basically we're probably hitting a peak or pretty darn close to it, and it's like 2 or 3 years of down before up starts again, and we're seeing that confirmed, I would say. Certainly the signal that we've seen in the last 2 days in the market is the first time since February that we've had a closing print on the S&P below the 50-day moving average. And I saw a note from our friend Ola Hansen over at Saxo Bank saying commodities are really starting to take off. That jibes with what you're showing on page 13, that's what happens after the equity cycle has already peaked. It really seems like there's a lot of corroborating evidence that all says equities are done here. Am I reading too much into that?
Well, maybe. I mean, it's never quite as binary as that, as you know, Egbert. I mean, I think the fact is that we're likely to see much more of a headwind for stocks if this is the correct judgment that liquidity is turning down. I mean, you can see this whole picture in an easier way through traffic lights, which we show on slide 15. And the point about that chart is that it basically shows to the left asset allocation, which asset classes you should be picking in different phases of the cycle, and then the industry groups that tend to perform on the right-hand side. Now, what that traffic light system says, and by the way, that this is not something which adapts to each cycle. It's something that I'm not going to say set in stone, but it more or less is. We've used this for decades, but it basically shows where you would normally expect to see returns from different asset classes, different industry groups. Now, what it says is that if you're in the rebound stage where, you want to be, just think about the traffic light. The orange light says proceed with caution. So that's saying that you want to overall in your asset allocation be prudent, but probably moving forward. Green lights are clearly go. So you want to be in equities and credits at that stage. Commodities, it's too early, and bonds, not really any interest. Then you go to calm and you start to see equities picking up more strongly, and you're getting the first sniff of action from commodities. Credits, you want to be maybe a little bit more cautious. I guess spreads have already narrowed a lot at that stage. Speculation, equities proceed with caution. Commodities sort of full green. That's where I think we are now. By the time you get to turbulence, you want to be out of equities. You maybe want to be sticking a toe back in the credit area because spreads may be more attractive. And bond duration gets the green light. And you think about industry groups on the right-hand side, very straightforward. You want to be in cyclicals in that upswing phase during rebound and calm. You want to be defensive otherwise in the downswing phases. Technology always leads, so it does really well in rebound and calm. You tend to find financials really picking up strongly around the mid-cycle calm stage. And then typically energy commodities do well later in the cycle. Now, I would say, despite the fact that we've had virtually no business cycle to speak of since the end of COVID, economies have generally flatlined, maybe for a host of reasons, one being the sort of strength of fiscal spend. What you've seen is a very normal liquidity cycle, and you've seen a very normal asset allocation cycle. I mean, this has been almost operating like clockwork. Technology were clearly the leaders. Financials have had a stellar 12, 15 months across worldwide. Commodity markets have been on fire. Mining stocks have been basically thrilling us this year. So it looks extremely normal from an asset allocation and a liquidity cycle standpoint. The puzzling element is clearly about reading the economy, because that's sort of pointing all different ways.
And I would suggest also that the obvious other elephant in the room has been an expectation or a desire among market participants to believe that this market weakness surely must have been all about the U.S. government shutdown. With the government reopening, well, we must be almost at the bottom and it's all going to take off again, right? It seems like you've got the good explanation for why maybe that's not true, but I think we should touch on that topic. Is there any validity to the idea that maybe what we're seeing here is just a sell the news reaction to the government reopening, and we're about to see a recovery?
Well, it could be. I mean, I think that, one has to be realistic here. And the fact is that, within the Fed balance sheet, there's an element that we've termed Fed liquidity, which is something we wrote about when we published a book 5 or 6 years ago called Capital Wars, which went into dissected a lot of Fed operations. And we came to the conclusion that it's not the overall balance sheet that's really the important element. It's really understanding parts of the balance sheet, those components that actually create liquidity for the markets. And if you look at that particular aggregate, that calculation, Fed liquidity, it's been under pressure over the last few months. I mean, really from a combination of reasons. One of those is being the end of the debt ceiling, where the Treasury General account, which had been pared down during the period where the federal government couldn't issue debt. It's been rebuilt. That's sucked money out of markets. And then lately, the government shutdown has further sucked more money out because there hasn't been there's been limitations on spending. So you've got the Treasury General account, which is, sounds slightly wonkish, but it's an element of the balance sheet where effectively the Treasury builds up its bank account at the Fed, but that is taking money out of markets. It's not circulating liquidity. And that has been now, it's over $1 trillion. And that will clearly come down as the government restarts. There's no question. So money will come back. The question is that the Fed has taken out over that maybe the last 6 months since the summer, about $500 billion, so $500 billion out of markets. It could put back with a government restart, maybe 150. So we're still going to be short. And that is being played out in bank reserves, where bank reserves are now well below the 3 trillion threshold in the US. And that's clearly causing problems in the repo markets. Now, I think what might be helpful is to try and understand why this is a problem and maybe what is coming down the track in terms of understanding this sort of whole debt liquidity nexus, which is really driving global financial markets as we see it. And there's a slide a little bit further on in the presentation on slide 21, which looks at a sort of schematic representation of the sort of the world financial system, if you like, post GFC. Now, what that slide identifies, it's, as I say, a schematic diagram. Right at the heart of that diagram is a debt liquidity nexus. And what it basically says is that you've got this paradox in the world economy where, as I've maybe emphasized, we're in a refinancing world where capital markets are really focused almost entirely now on refinancing existing debts. I mean, if you take out a debt, unlike an equity security, you've got to think about rolling that debt. You know, spoiler alert, debt is never repaid; it's only just rolled over. You've got to roll that debt on average in 5 years' time, and that causes a great burden for financial markets. So if you think of the very simple math here, if you've got $350 billion trillion dollars, I beg your pardon, $1 trillion of debt in the world economy with an average term of 5 years, you're asking capital markets to roll over 70 trillion of debt every year. This is a huge amount, and it's only getting bigger. Now, if you look at how this system works, you've got at the heart of the system this debt liquidity nexus. The paradox in the system is that debt needs liquidity for a rollover, but liquidity needs debt as collateral. It needs existing debts as collateral. Now, that's the paradox. And something like, as you can see from the chart, 77%, very precise figure, but that comes from the World Bank, 77% of all lending worldwide now is collateral based. So that doesn't mean to say your home mortgage or real estate has got is collateralized. It's not just that. It's saying that a lot of financial lending is actually collateralized using US treasuries or German bonds. Think of the hedge fund basis trade that is underpinning the US treasury market. A lot of that is, or the bulk of that, is collateralized on treasuries. So this is really a very important element. And the point about this diagram is that what you need is an equilibrium there. And that equilibrium is a balance between the amount of debt and the amount of liquidity. If you have deficient liquidity, you're going to get a financial crisis. If you have too much liquidity, you get an asset bubble. Now, if you take a look at the following slide 22, that gives the history of that particular ratio. And what that shows is the debt liquidity ratio over time. Now, I've often sort of been puzzled by the idea of why do economists look at debt to GDP? And I've never really understood the logic for that. Maybe it's because it's an easy calculation to make. And like so many things in economics, you know, what is most easily measured seems to take on the greatest importance, whether it's relevant or not. And I think that's the same with debt GDP. This is looking at something which is practical, which is saying, let's look at debt liquidity. You need liquidity to roll debt. And if you look at that series, it's basically a stationary series that mean reverts. And it seems like there's a level of about 200%, in other words, 2 times debt to liquidity, where you get an equilibrium. Now, if you stray above that equilibrium, if you go way above the 2, you'll see there that you get spikes, which I've annotated, which happen to be global financial crises. And that's when you get refinancing tensions in the system because there's too much debt, insufficient liquidity. You can't roll the debt. And so financial markets get indigestion. If you look at the opposite of that, if you go down the page and you look at the low periods of the debt liquidity ratio, when there's abundant liquidity in the system, you get asset bubbles. The vent of that excess liquidity is asset prices. And you can see where we've just been coming from, something called the everything bubble. Now, that is an astonishing displacement downwards of that ratio, and it's clearly been propelling markets ever higher. And you can see that it's now coming to an end as that line picks up. Now, we can go down two rabbit holes here. I mean, one is to look at the history of asset bubbles, which I think was the second slide in the deck, which is just something I snipped from Twitter, which was a chart on asset prices in bubbles since the mid-1970s. And I just, as best I could, overlaid on that our global liquidity cycle, just to show that almost every bubble, coincides with a prior period of excessive liquidity, pretty much as this slide 22 confirms. But the question is, why did we go down so far in that ratio? Why was there so much liquidity relative to debt? And now why are we going up? And that's really the second rabbit hole. Now, if you think about why we went down, it was simply because we reached a situation after the GFC and after COVID where policymakers just plowed liquidity back into the system to try and put us back on the rails and right the system after those significant crashes or collapses. Liquidity was the solution. It's now become the problem. And the other thing is that interest rates were slashed to zero. Now, if you've got worries about debt, why do you want to incentivize people to take on even more debt by getting interest rates to zero? That seems to be a completely crazy policy to enact. But it also encourages a lot of borrowers to term out their debt later in the decade. So if you look at the next slide, and I'll stop after that, but if you look at the next slide, slide 23, that shows for the advanced economies, what's called the debt maturity wall. And this is our calculations, but it basically shows the incremental increase each year in the amount of debt that needs refinancing. And you can see, this is for, as I said, the advanced economies, you can see the bite out of the chart in the COVID years, 21, 22, 23. And why did you see that bite? Because low interest rates encourage borrowers, governments, corporates, households to refinance their debt, term it out, in other words, push it back to the late 2020s. And that is now coming back full steam into capital markets, and it needs liquidity to be refinanced. So that's why the ratio is going up. And that looks fairly threatening for the next few years. Liquidity is desperately needed. And that's not what policymakers seem to be wanting to do.
This slide 23 really speaks to me, Michael, because we've discussed this narrative for the last 10 years about, boy, we're going to run into this problem, interest rates going back up. It's going to be hard to refinance U.S. government debt. It comes at a time when geopolitical relations are such that many countries are questioning their commitment to U.S. treasuries as their primary reserve asset. That's a great narrative, but boy, you look at slide 23 and what it says to me was a good narrative, but we didn't really have a big problem until about 2024, and it gets worse in 2025. And wow, for the next 5 years, who the heck is going to buy all of that U.S. Treasury paper at a time when, even before we had this maturity wall hitting us in the face, it was already getting difficult to continue to rationalize that sale of U.S. Treasury paper because of geopolitical developments? Am I reading too much into this, or is this a really scary slide here?
Oh, I think, Eric, you're not reading enough into it. I think the reality is, remember, this is refinancing existing debt. This is not talking about the new debt that's coming down the track as well. So you've got on top of this for the US another $2 trillion every year of new debt. So I think we're burying ourselves under paper here. I mean, this is the problem. And so you need more liquidity. And this is why the monetary debasement trade is so popular, because the only way governments can kind of get themselves out of this is to basically start printing money. Now, you can see the tensions which are forcing governments into a corner on the next slide, which is looking at the repo markets, which is very topical right now. Now, the issue that we raised is that if you start to see problems between the amount of debt needing to be refinanced and liquidity, you're going to start to see tensions in the repo markets, which are the main refinancing arena, certainly post the GFC. And what slide 24 shows is the spread between repo rates, which are a market-based rate, and Fed funds, which is clearly the administered rate by the Federal Reserve, the targeted rate. And you can see how that spread is evolving over time, over the last 3 or 4 years. Now, it's not so much the extent of the divergence that's really important here. It's the frequency. And what you're seeing is more and more evidence that the repo markets are sort of struggling under the weight of refinancing demands and the lack of liquidity. And normally you'd expect to see, as that chart initially shows, a negative spread because SOFR rates, which is the main repo rate, are collateralized, whereas Fed funds is not. So you'd expect actually SOFR to trade a tad below Fed funds. And actually what you're seeing here is it's trading well above. And paradoxically, the Fed's recent interest rate cut has been virtually wiped out now by the markets in terms of the rise in SOFR. So the Fed has lost control of the interest rate setting mechanism. Now, at the moment, this is purely an inconvenience for the Fed, but it could turn into a bigger problem down the track. And one of the things to see is to look at a couple of slides on, which I think is slide 27, which is looking at bank reserves in the US, which is really the counterpart to liquidity in money markets. Bank reserves are shown as the orange line in terms of their deviations from what we deem to be adequate levels of reserves or minimum levels of reserves, and the numbers of failed trades that you're getting in among primary dealers in these markets. Now, primary dealer trade fails are shown in black inverted. So when that black line falls lower, it's actually indicating a big spike upwards in failed trades. And what you can see is that as bank reserves dip, so you're seeing this process of increasing trade fails. Now, that's only going to lend to volatility in financial markets and certainly in the bond markets, and that's really a concern. And if you want to understand how we got there, just take a look at the two prior slides, 25 and 26. 25 is looking at the aggregate we described as Fed liquidity, which is basically the liquidity components of the Fed balance sheet. And this, comprises both their QE policies, their QT policies, and what we've, slightly tongue-in-cheek labeled not QE, which is sort of the Sula Tabla or backdoor liquidity injections that can come, through running down the reverse repo account, through the bank term funding program, whatever. You look at slide 25, which is the Fed liquidity growth, and you can see basically where we are right now, which is this big drop in the growth in liquidity. So actually Fed liquidity is falling in absolute terms. And that's because of these factors such as the end of the debt ceiling, the government shutdown, etc. There's some recovery for sure, but it looks like a fairly limp recovery. And even to get there, we've assumed that we go back to a QE. I've used the word QE, the dreaded word. We go back to a QE of maybe 250 billion next year. But that's still not enough to really lift Fed liquidity growth. And you can see the impact of that if you go to the next slide, 26, which is the counterpart. So think about Fed liquidity initiates the liquidity impulse. It goes into money markets, and it ultimately appears as bank reserves excess or whatever levels of bank reserves. And you can see here our estimates of bank reserves. So we've estimated bank reserves by looking at when you get tensions in repo markets, and that gives us a plot for minimum levels of reserves, and we show actual reserves against that. And the prior chart we looked at earlier, slide 27, is the one that shows that displacement relative to failed trades. So you can see where we are now. The Fed has basically let US bank reserves fall below what we think is the critical measure of about 3.3 trillion. And that is why you're getting the tensions in markets right now. And I'll end this bit on just looking at one further slide, which is slide 29, which is comparing Fed liquidity in absolute terms with the S&P. And the S&P has been lagged by 6 months to show it has, it follows on, not directly one for one. But, if I was looking at that chart and, spotting the fact that Fed liquidity was dipping as sharply as it is, I'd be fairly worried about the health of Wall Street, if you get my point.
Michael, let's move on to page 30.
Yeah, let's focus on that, Eric. What it's looking at is a slide that basically disaggregates the various sources of stimulus that are coming into US financial markets in liquidity terms. And what the chart is looking at, there are three divisions there, two which concern the Fed, which is the orange and red areas. The red area is conventional QE, so that's balance sheet expansion by simply buying treasuries. The orange bit is what we've, as I said, called slightly tongue-in-cheek, not QE, which is really the backdoor liquidity stimulus, which comes from things like the bank term funding program, the rundown of the reverse repo account, etc. Other sources of liquidity. And that's really what you would call Fed QE. And that's been something that clearly has lifted Wall Street. It's benefited wealth owners in the US. But it's something that, Treasury Secretary Bessent has railed against, and more particularly recently, new FOMC appointee Stephen Miran. And what they're talking about is actually focusing much more on what I've labeled Treasury QE, which is the black area. Now, that basically is concerns something that Miran wrote about. We've also focused on, which is looking at changing the issuance calendar in the US towards bill finance or very short-term debt finance of the government. And because that changes the structure of debt in the system, although this sounds wonkish, it actually is equivalent to a liquidity injection. In other words, if you're issuing a lot of treasury bills, the question to ask is who buys those bills, and it tends to be banks. And if banks buy government debt, technically, it is monetization of the deficit. Now, the little window in that chart is basically overlaying on the liquidity stimulus the growth rate or the cycle of the US economy. And you can see that the two line up pretty well with a lead time of about 9 months. So it should be that the real economy gets traction in 26, contrary to what a lot of people are talking now about recession. I think it's going to be the opposite. You get stronger growth. Now, this is not just a US phenomenon of this monetization of debt. It's also a global phenomenon. And if you look at slide 32, this is looking at the scale of monetization of fiscal deficits and government debt by banking systems worldwide. And the point is that this shift from longer dated debt issuance towards shorter dated debt issuance is a subtle way of governments getting banks to finance them through printing money, because banks love this short-term paper. And that's exactly what they're doing. So if you look at that slide 32, that's worrying for monetarists, because what it's likely to be telling us is that more traditional M2 money supply growth could be actually accelerating into next year. And, our back of the envelope calculations would suggest that US M2 conventional money supply could be growing at something like, 7-8% in 2026, which is clearly incompatible with a Fed 2% inflation target. So this is the longer term problem that the system faces. Now, that's one reason why you want real assets as a protection against this debasement. But there's another reason, which is basically China. And if we look at what China is doing, take a look at slide 38, which is a jump forward, but it basically looks at the debt to liquidity ratio of China, and it compares that with Japan, which is the black line on that chart. Now, as I tried to argue, debt liquidity ratios are the equilibrium in the system. And what you need to do is to get out of or away from a high debt liquidity ratio and to pare that down to more average levels. And you can see Japan has successfully done that. And despite the fact that Japan's debt to GDP is sky high, its debt to liquidity has been brought down significantly because of Abenomics and because of the Bank of Japan buying lots of JGBs, Japanese government bonds, monetizing debt, causing the yen to weaken significantly. And by the way, it's still weakening, despite the, a lot of brave words about how the yen is so undervalued. It's responding to this monetary inflation by devaluing. China is doing the same thing now. It is being forced into a devaluation of its currency. It wants to print money. This has been, I think, accelerated by the stablecoin phenomenon in the US. It's threatened, monetary system is threatened greatly by this. And you can see on the following slide, slide 39, the scale of the impulse that the PBOC has just added to markets in 2025. They've been sitting on their hands for quite a long time. They've been running a tighter policy to try and protect the yuan against the US dollar. And my view is that that's doing two things. One is that big liquidity impulse is driving the gold market up, which is what slide 40 says. And I think we've got to start thinking about how China is controlling gold now. And that is another sort of ultimate segue into the future monetary system. And then finally on slide 41, what you see there is is a track of Chinese liquidity, which is taking a longer term view using our indexes of the Chinese liquidity impulse against commodity prices. And you can see there that in the black lines, either with or without energy, the impact of Chinese liquidity on commodity prices. And the fact is that China has a big economic footprint globally and in the Asian region. And if the Chinese economic engine gets going again, it's going to suck in commodities. And that's going to drive prices up. So I think we're absolutely at the stage where commodity markets do well.
Okay, you've said that a couple of times now, that commodity markets should do well, and we're maybe getting to the point where equity markets are reaching a peak. What does that mean for the commodity stocks, the mining stocks? Are they likely to continue to do well along with the underlying commodities, or are they going to be affected by the pressure on equities?
Argue this in a number of ways, Eric. I mean, one is that if you look at these, many of these mining stocks on traditional valuation grounds, or even compared with their history, they look cheap. So I think there's no question about that. There's compelling value in them. But the thing is that a mining stock has two moving parts, the E and the PE. And the E is going to move up strongly as commodity prices rise, assuming, let's say, that oil remains or lags, because one of the things that tends to affect mining stocks is the cost of extraction, and that tends to be energy related. So, looking at the commodity price to oil ratio is clearly a decent heads up for that for those profit margins. But assuming that is going upwards, then you're going to get further earnings expansion for these stocks. But the question is the PE, and the PE, sadly, is also a sort of a function of general levels of Wall Street. So if markets sell off, it's going to be very difficult for mining stocks to gain dramatically. They may well outperform because they've got stronger earnings, but it's a difficult judgment. So I think that you're on safer ground looking at the underlying commodities in this at this time. But I'm still favoring mining stocks. I think that they've got decent value behind them.
I want to just assimilate this entire slide deck before we move on to go a little bit deeper into this question of stable coins and re-architecting the monetary order, which you've got an excellent paper, again, linked in the Research Roundup email for our listeners to download and read. Let's just take this all into perspective, Michael. If you had showed me this slide deck 3 weeks ago when the S&P was testing new all-time highs at 69.50 or whatever it got up to, I would have said, boy, this is a really compelling argument that says we're nearing the end of a cycle. The big question now is, okay, when's it going to crack? Gosh, Michael, just in the last 24 hours, as we're recording early on Tuesday morning before the European Open, we've seen the S&P break down to its first close below the 50-day moving average for since February, and the last time it happened, it was 1,200 points down from there. Did it just crack? And if so, it seems like maybe this is a pretty big deal and a pretty big signal.
Yeah, it could be. I mean, I think the thing is that if you look at investor sentiment measures, so this is what retail investors are doing. I mean, there doesn't seem to be a huge overextension in markets. So this is not about, let's say, excessive valuation concerns. This is much more about the flow of liquidity. And you can see the breakdown on the flow of liquidity by looking at the repo market in the US. That's a fairly decent heads up. I mean, it's only a US metric, but it's certainly important. And the repo markets certainly are not behaving very well. And they're not behaving very well simply because the Federal Reserve has pulled the rug away to some extent. And what I would go back to again is the comments that Stephen Miran has made recently about saying, okay, what we want is the balance sheet down and we want interest rates down. And that says to me that they want to direct the hose away from the Fed and sort of soaking asset markets with actually directing the hose more precisely into the real economy and trying to get Main Street driven forward. And that means, sort of defense procurement. It means critical minerals. It means taking strategic stakes, etc. And it comes back to this general idea that we've been talking about for some years. This is a capital war, not a trade war. I mean, a trade war is a veneer on top, but it's really a capital war. This is a struggle for, if you like, dominance of the world economy in terms of currency and capital. And America wants to win.
Well, from page 23, we know we're facing this massive refinancing wall that comes at a time when the relationship between the U.S. and China is under extreme pressure. All indications are that China is buying gold hand over fist, apparently to replace their prior dependence on U.S. Treasury paper as their primary reserve asset. You wrote an excellent paper, which is linked in the Research Roundup email. It's called The New Currency Wars and the Gold Bitcoin Axis, America's Digital Collateral versus Chinese Gold. In the time we have remaining, give us a quick rundown of what this paper is about.
Let me also flag Brent Johnson, because he's done very similar work. He probably makes the case more eloquently than me, but he's been a great advocate over the years of the milkshake theory, which you're familiar with. And I think a very good way of understanding the milkshake theory is to look at slide 35, which basically is showing the big inflows into the US dollar. And this is something which has clearly occurred almost uniquely since the GFC. There's been a redirection of money flows into US assets and the US dollar for a whole host of reasons. But clearly it's been a fact, and that has propelled US dollar higher over the years. And that, Brent is very clearly called the milkshake theory. I think what we've got now is a milkshake theory with two straws, and not just this sort of dollar straw, but we've also got a stable coin straw. And I think that explains an awful lot about the reaction of China in recent weeks to these developments, and why it's putting a lot of liquidity into its markets right now. It wants to repair its financial system quickly, and it also explains why China is buying a lot of gold. Now, what I think you're getting a financial system worldwide that is cleaving into two parts. One part which is being backed by gold, which is China, and China is clearly accumulating gold. It's a big gold producer, it's now the world's biggest, but it's also buying on the open market. And, some market experts, as you'd be familiar with, are actually suggesting that China has actually managed to accumulate something like 5,000 tons of gold officially, way, way above what the slated amount is that the data shows. So they're doing this, surreptitiously, but they're doing it by stealth, but they're still doing it. And that gives them the ability to back their currency by gold. Now, it's important to say that this is not a return to a gold standard. Fundamentally, no, it's not, because they still need fiat, because they need fiat money to basically fund the government in the same way that America does. But America is not backing its system with gold. It's using a stablecoin, and it's basically wrapping treasuries within a stablecoin wrapper. So what you're getting is essentially digital collateral in the US versus gold or tangible collateral in China. And what America is implicitly saying is trust our technology. And what China is saying is trust our gold. And that's how the two systems are basically working out. Now, stablecoin is a big threat to China. And just to understand that, just think of the squeals that are coming out of Europe now about the unfairness of US stablecoin. And, a prominent member of the ECB said only yesterday, look, this is unfair competition, because if the US starts issuing stablecoin to European residents, Europe is going to lose control of the monetary system. Well, let's just read that for China too, because China's got a much, much bigger problem. And the way that I envision it is to say, look, if you're a Chinese exporter, you're facing sort of the choice between the devil and the deep blue sea at the moment. You can put your money, your dollar earnings, into a Western banking system, and you can risk sequestration, rather like the Russians faced after the invasion of Ukraine. Or you can put it back in the domestic banking system and risk sequestration by the Chinese authorities, by the PRC, if you do a Jack Ma and fall foul of the authorities. So it's a straightforward decision, I would suggest, to start putting your money into stablecoin. It's easy to open a stablecoin account, easier than opening a bank account. And what's more, there's some degree of anonymity in holding them. So the Chinese must be really scared by this. And that's why I think they've been triggered into stabilizing their financial system, trying to buy a lot of gold, issuing lots of liquidity to try and repair the debt problems, because we're facing this capital war. So it's really a question of saying trust our gold versus trust our technology. It's in America's interest, I would suggest, maybe controversially, to say, actually, we want to destabilize the gold price because a much higher gold price will benefit China. And it's in China's interest to attack US technology through cyber warfare and maybe quantum computing, to say we want to undermine the fabric of US society, which is very technology dependent. So you've got these two entities at war using very different weaponry.
In the interest of time, I'm going to have to refer our listeners to your excellent paper for more context on this. But I have one final question before we close, which is how do I make sense of what this means for the gold market from here? Because on one hand, I could see the argument that, hey, China is going to continue buying gold hand over fist. It's going to drive the price higher. You got to stay long gold. We're maybe at a bit of a low point here. It seems like a good buying opportunity. Go, baby, go on gold. But then I could see the other side of this, which is President Trump is very much engaged aggressively in negotiations with China. He has, as far as I can see, a very, very strong incentive. And there's no doubt in my mind that Scott Bessent understands all this stuff and is coaching him on what it all means. To say, look, China, we got to cut a deal here somehow where you guys back off on the gold buying and go back to U.S. treasuries, and we'll make it good for you by wrapping them in stablecoins, and we'll make a promise to you that we're not going to do to you what we did to Russia. How do I balance those two ideas? What do you think the outlook is for gold here?
I think you've got to play the trends, Eric. I think that's for sure. I mean, both commodities, gold and Bitcoin are volatile. We know that. But, if you take the longer term view perspective it's not a question of gold or Bitcoin. It's a question of gold and Bitcoin. You need both of those assets for the reasons that I've just explained. And I think if you look at the longer term perspective, just consider the growth in federal debt. US federal debt since year 2000 compared with now is up 10 times. That's an eye-watering figure. The S&P has managed to gain less than 5 times over that same time period, but gold is up 12 times. So gold has more than outpaced the increase in federal debt. So if you start to extrapolate into the future, you're looking, even taking Congressional Budget Office data, that the debt GDP ratio of public debt to GDP for the US is going to test 250%, so more than doubling from where we are now by 2050. That would suggest that if you just use that same timeline and assume that the real value, the gold value of federal debt stays where we are now, not an outperformance by gold, the gold price should be $10,000 an ounce by the middle 2030s, and it should be $25,000 an ounce by 2050. Now, that will be higher. We'll live to see that, I'm sure. But, the fact is the trend is there, and you've got to play the trends. And people need, essentially, hedges against this monetary inflation. And my point has been that we're in a monetary inflation world, not a financial repression world. There's a subtle but a really important difference.
Well, Michael, I can't thank you enough for a terrific interview. I really want to encourage our listeners to download all 3 of the attachments in the Research Roundup email. That's the slide deck, which we didn't have a chance to get to every page in. I recommend that everyone peruse the pages we missed because there's a lot of great content there. But particularly the 2 papers that you shared with us, both are excellent, and I highly recommend them. For people who want to go further than that and find out more about what services are on offer at Global Liquidity Indices, how do they follow your work? How do they contact you? And what services are on offer there?
Okay, Eric. Well, the easiest way is to look at Substack. We have a Substack called Capital Wars, where we provide both data and narrative, and we publish about three times a week on average for that. We've transitioned from a company called Cross Border Capital, which I founded. We've now focused a lot on global liquidity indexes, but the old website, crossbordercapital.com, still exists and works. And that's where our institutional research offering is still provided. So those are the 2 main conduits I would suggest. And there's a Twitter account at crossbordercap.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Michael back on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Michael's picture saying looking for the downloads.
Patrick, what was your main takeaway from Michael Howell's interview, and how can we design a trade to express that view?
Well, Eric, the big takeaway from Michael Howell is that the Fed is shifting into a regime where cutting rates becomes not just likely, but necessary. Liquidity pressures in the repo markets, accelerating Treasury issuance, and a policy pivot towards supporting Main Street all point to the same direction. policy rates are heading lower and probably faster than the market is pricing. So for this week's trade, I want to position directly for that outcome. Now, just yesterday, the odds of a December cut have faded after the jobs report got pushed into mid-December, and that timing kink has completely scrambled the front-end narrative. But in the bigger picture, that kind of short-term confusion is the opportunity. The December 2026 SOFR contract is trading around 96.90, implying 310 basis point Fed funds at the end of next year. The trade here is straightforward. Markets are still underpricing the probability that the Fed will be forced into a much more dovish pivot. Whether it's liquidity stress or collateral dynamics, the setup argues that the strip will need to reprice lower policy rates on the order of another 50 to 100 basis points of cuts being baked in. So the play is to own the convexity now while the market is temporarily distracted by a timing noise rather than the bigger macro shift. To express that view cleanly, I'm looking at the 3-month SOFR December 2026 97.5 to 98, 50 basis point wide vertical call spread. It costs 8 points, which means that you're laying out 8 basis points of risk to make a potential 42 points profit, roughly a 5-to-1 payoff if the rates markets price in deeper cuts. It's a capital efficient way to own the dovish pivot narrative with fully defined risk.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent trade of the week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's get into these equities. What are you thinking of the markets here?
Patrick, I think it's really important that we keep a close eye on what happens next in the equity market because, last week the story was, look, okay, as soon as we get the government shutdown resolved and the government reopens, it's going to be off to the races and everything's going to be fine. That's what happened, and it lasted for about a half a day, and then we were rolling back over. And then it was, but that's just because we're the market's waiting for NVIDIA earnings. And once we get NVIDIA earnings, if we get a positive print there, it's all going to be fine. The market's going to be rally. It's going to be great. Okay, now we've got an absolutely outstanding NVIDIA earnings print. So the market is supposed to recover. Well, look, we've been struggling below the 50-day moving average. This is the first time we've seen a breakdown to the downside below the 50-day since the 21st, I believe, of February. So the operative question, I think, is can this market get back above the 50-day moving average and stay there? And that means we need to see a pretty brisk rally from here. If we don't get it, in other words, if the market expectation was that as soon as the government reopens, it's all going to be fine. Oh, wait, that didn't work. As soon as NVIDIA earnings comes out, it's all going to be fine. If that doesn't work either, I think we really have to question where this market is headed and how much lower can go. But Patrick, you're the technician in the house. How much concern or non-concern do you have about the first daily close below the 50-day moving average since February?
Well, Eric, we've now officially had our first 5% market correction from peak to trough and a short trip below the 50-day moving average. But here are some of the bigger picture things that we can't lose sight of. One, market breadth continues to deteriorate. We're at 34% of stocks above their 50-day moving average in the S&P 500, which means basically 2 out of 3 stocks are in a definitive downtrend. While NVIDIA has certainly spurred the market cap weighted S&P higher and the NASDAQ a little bit higher on its positive earnings reaction, we still have a definitive downtrend and very little reaction to things like the equal weight S&P 500 index or the Russell, which both are in clear breakdown mode. The financials continue to be very weak. So the underpinning market is structurally very, very weak. Now, think back to December of last year where we had a similar type of a drop going into the Christmas period below the 50-day. The market mustered up a rally all the way back to its previous high for a double top retest. That prolonged the whole sequence by a month, but inevitably the market correction did start in February of this year, when that became that Liberation Day market drop. In the same manner, we may very well still be in a bigger topping formation, and maybe NVIDIA has lightened up some of the pressure, which may allow this market to do some retesting of its highs, but it's incredibly premature to start making a bull case narrative. If anything, I think this is a bigger topping formation that may define the fourth quarter. All right, Eric, let's talk about this dollar.
Well, the Dixie's back up to flirting with 100 again, actually above 100 on Wednesday afternoon, but still hasn't broken out to the upside, at least not yet. The dollar trend reversal to the upside or the continuation to the downside is going to drive a lot of other markets in the opposite direction. So we really need to see what happens next here and watch the dollar closely. And as of recording time early on Thursday morning, it looks like the rally may be continuing, and we might be starting to see that upside breakout on the dollar. If that happens, it could be bad news for other risk assets.
Well, in my eyes, Eric, this dollar breakout is for real. And this actually is something that should be a caution for bulls, because the reflation trade has been dominant for the last 9 months, and it was all backed on a weak U.S. dollar. Now, if this U.S. dollar breakout gains any momentum, it certainly is going to be a headwind for almost all of those investment themes. Now, overall, we have a fresh breakdown in the euro, almost breaking to a lower low. The pound sterling definitively already broken down. A U.S. dollar yen that is absolutely screaming higher. The U.S. dollar against the Canadian dollar turning up. You basically have synchronized U.S. dollar strength right now, right across the board, and it may only be gaining momentum. There's going to be a lot of knock-on effects from an intermarket perspective. This cannot be ignored. Keep watching this U.S. dollar for a potential bull continuation. All right, Eric, let's talk about oil here.
Well, it looks like the price of crude is trying to firm up again, both flat price and front of curve time spreads moving back into backwardation, at least for the first several months out on the curve. I place more credence on the latter, that is the time spreads, than on the flat price. And let's see what happens here. But it looks like maybe oil wants to make a recovery here. Per Michael's comments in the feature interview, commodity outlook should be bullish from here. But wait a minute. Trump badly needs and wants lower gas prices into the midterm elections. And it's very clear from President Trump and Secretary Bessent's comments that they want to pump up Main Street, not Wall Street. So, and I think that extends to they want to pump up Main Street as opposed to doing favors for their buddies in the oil patch. So I think the writing's on the wall here with MBS in town meeting with the president. Maybe some kind of deal, invisible hand is in play here, and a deal has been struck to allow oil prices to continue to move lower into the midterm elections, get gasoline prices in the U.S. down under $2, and then run it back up after the election. Obviously, that's wild speculation on my part. I have no evidence to support that, but as far as I can see, the handwriting's on the wall.
Well, Eric, crude oil remains at the bottom end of that range. Now, what's interesting is the last 1 month consolidation, which had every opportunity to legitimately break down and start selling, sending the crude oil down to $55 or lower. It hasn't. And in fact, every time crude oil has done a breakdown candle, the bulls have quietly bought that dip. And generally, the $58 to $59 level has been defended. What we're going to be watching is whether or not the bulls can actually attempt a breakout candle. Now, that has not come yet. We still have no violation of the descending trend line connecting all the highs. It's still below its 50-day moving average. The primary trend is still down, but it is no longer in sell mode. It is in a quiet accumulation phase. And I'm going to be watching for whether or not some catalyst, maybe like an attack on Venezuela, could spark a short-term breakout that could feed into a short squeeze on the upside. Now, Eric, let's move on to gold.
Looks like we're starting to form a pennant or symmetrical triangle formation on the gold chart. I still think there's lots of upside left to go in this bull market. Michael agreed with that in the feature interview. So let's see what happens. But, this isn't resolved yet. We've seen a correction that who knows how long it's going to last. The last correction in gold took us quite a bit lower before it resolved. And we're right kind of, I think, on an inflection point. Looking at the chart, we need to see this sustained uptrend and stay above the 50-day moving average. As long as that happens, I think maybe it's upside from here, but there's plenty of room for more downside without breaking the longer-term bullish trend.
What's interesting about your view about the pennant or symmetrical triangle formation is that that's exactly how the previous three consolidations in gold have played out. Now, what supports that is the fact that these dips are being bought. It is holding above its 50-day moving average, and so it is generally being defended. Overall, the previous gold consolidations lasted anywhere from 2 months to 4 months. So I would just basically expect that there's going to be continued gold consolidation into December, and at some point in the first quarter of next year, there will be another opportunity for gold to break out again. Right now, just expect more of this kind of ping-pong match between support resistance levels as it consolidates into the Christmas period. All right, Eric, let's move on to uranium.
Well, Patrick, I'm adding to my longs here. Frankly, I'm not sure if this correction in uranium and uranium miners is over. The big risk to it was an unwind of the AI trade. Now, we just saw a really positive earnings print from NVIDIA, so it seems like the AI trade is not unwinding quite yet. And URA, the uranium ETF that has the most liquid options chain, has gone from overbought to oversold. I really like the 50 and 55 strike calls here. The market started to turn back up on Wednesday afternoon. Let's see if that lasts into Thursday. Especially on the back of NVIDIA, we want to see a brisk rally from here. Now that the question of AI falling apart seems to be at least on the back burner. If that doesn't happen, it makes me quite concerned that we could see a much deeper correction before this is over.
Well, certainly, Eric, now that we have pulled back 30+% off of the highs on the URA, that there is certainly the opportunity to start entertaining the idea that there's going to be levels here that are buyable. Overall, though, the price action remains distributive, so it's a very early speculation about catching a bottom. I'm going to be watching to see whether or not the price action really starts to show that the price levels here are being defended, and this is going to be where the bulls are going to take a stab at getting this back into bull trend back above the 50-day moving average. This is certainly a tactical moment to see what happens, but I'm a little bit more of a wait-and-see mode here on this. When we specifically look at that Sprott Physical Uranium Trust, that has been in a much bigger consolidation for a month. I generally am more bullish uranium prices because I simply think there's more asymmetry in the opportunity here, but certainly if you're looking for the higher implied volatility in your returns, then accept no substitute for those uranium equities.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Yeah, well, Eric, on that 10-year Treasury yield, ever since the last FOMC meeting, we've basically seen the 10-year Treasury yields rising, but we still haven't seen a legitimate sequence of a higher high where a new bull trend has started in the yields. Overall, this was a very oversold kind of market that is now counter trending, and with the fact that the jobs numbers have now been pushed out to middle of December, increased likelihood that the Fed just holds on the December meeting means that all of the rates markets may actually just be muddled in here for the remainder of the fourth quarter, and that the next kind of major move in yield markets is going to emerge in the new year. So at this moment, could we still see a quick rip to the 4.25 level on the upside of the yields? It's totally on the table, but generally I think that mean reversion and it trading more or less around this current level for the next month is probably the most likely outcome.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.